All righty. Thank you so much for joining me. We are going to get right into this right now. So this is first time homebuyer toolkit. We're going to be talking about quite a lot today. So strap in. Thank you for spending your lunch with me. And yeah, we're going to get right into it. So wanted to start with a little bit about myself. I've been in the mortgage industry now since 2009. I got my real estate license in 2008. So if you have a question, I will absolutely have an answer for you. When I'm not doing mortgages, and by that I mean I originate loans myself, it also means that I actually lead a team of loan officers and teach them how to do their job better. So I'm both an originator and a manager. When I'm not helping out loan officers or originating loans, I love to go on motorcycle rides. My Irish setter named Finian is, you can kind of see him in the background a little bit. I like to go on motorcycle rides with him. I love to do yoga, play soccer. I play soccer 1 to 2 times a week. And yeah, I'm an avid sports fan. I'm one of those people. So, alrighty. So here's what we're going to be talking about today. Like I said, it's quite a lot. So we're going to be talking about the different types of mortgages that exist. We're going to be talking about loan considerations, what a lender considers when they get you pre-approved for a mortgage. Talk about the pre-approval process. Talk about working with an agent. How do you find an agent? Shopping for a home. And then the collateral questions as well. So but getting a house is a little bit unique. The lender cares about what you're buying. If you were to buy a car, the lender doesn't ask to see what the car looks like. They don't ask to take it on a test drive. Well, that's not the case with buying a house. The property you're buying definitely does matter from a lender's perspective. We'll talk about the contract process. From when you go into contract to closing, what does that process look like? And then finally closing itself. So lots to get into. If you have any questions, please let me know. You can drop it in the Q&A function and we will go from there. All right. So let's talk about the different types of mortgages. Okay. So there's three different buckets that mortgages fall into. First type is what we call a conventional mortgage. Conventional mortgages just mean that the investor behind the loan, whose money it actually is Fannie Mae and Freddie Mac. Okay. Fannie Mae and Freddie Mac are government-sponsored enterprises. Okay, they're not directly the government, but they are supported by the government. We typically think of conventional financing as Plan A. If we can go with conventional financing, we are absolutely going with conventional financing. It is the best type of loan, objectively so. Second type of loan is what we call government financing. FHA, Federal Housing Administration, USDA, U.S. Department of Agriculture, VA, Veterans Affairs. Those are all truly government loans. Okay, those are actually the government's money that you are borrowing when you get a government mortgage. We'd like to consider government loans a Plan B. I'll be talking about why they have a little bit of a disadvantage compared to conventional Plan A. The third type of loan is what we call a portfolio loan. Okay, portfolio loan is car loans. Okay, personal loans. All of that means that the investor behind the loan is the institution themselves. Okay, it is no longer government-backed money. It is no longer actual government money. It's just the financial institution's own money. We'd like to consider that Plan C. So Plan A, conventional, Plan B, government, Plan C, portfolio. And we're going to be spending most of our time talking about conventional financing. It is objectively so, like I said, the best type of loan, has the best loan terms, best rates, best costs. If we can go with conventional, we are absolutely going with conventional. Now, within each of these three different buckets, there's different types of loans. Okay, the most common by far and away is what we call a fixed rate mortgage. That's where the interest rate is fixed for the life of the loan, the entire loan term. Okay, they typically come in 30, 20, 15-year, or 10-year formats. By far and away, the most common loan, especially right now. The second type of loan is what we call a hybrid adjustable rate mortgage. You'll hear them called ARMs, ARMs, like the arm that's attached to your body. Hybrid adjustable rate mortgage. Now, adjustable rate mortgages got a little bit of a bad rap during the housing crisis. Okay, they oftentimes didn't have limits to how high they could increase. They could start to adjust right away on day one. That was a problem. Well, today's ARMs are what we call hybrid ARMs. So it has an initial period of time where the rate is fixed. And then after that initial time is when the rate begins to adjust. So if you ever hear about a 3-year ARM, that means the rate is fixed for 3 years and then it's subject to change. 7-year rate is fixed for 7 years and then it's subject to change. So for that initial fixed period of time, the hybrid portion of that, the fixed portion of that, it's going to be the exact same as a 30-year fixed. Okay, it's fully amortizing, your rate is stable, your payments are going to be pretty stable as well. After that is when the rate can begin to adjust. Now, with an ARM, they have different formats. So our 3-year and our 5-year ARM is what we call a 2-1-5 format. So they can adjust 2% the first adjustment, 1% each adjustment after that, to a maximum of 5% above your initial rate. 7-year and 10 years, a 5-1-5. So it can adjust 5% the first adjustment, 1% each additional adjustment, 5% overall. Why would somebody do an ARM? It's the right question to ask. Well, there's a couple reasons. One, the rates do tend to be a little bit lower, especially right now with rates being elevated and with times being tough for a lot of people. ARMs are starting to pick up a little bit more steam than they were during COVID-19 when rates had just plummeted. Okay, so one, yes, you get a little bit of a break on your interest rate. Another one is if you are pretty confident that rates are going to drop in the future, well, great. An ARM doesn't just adjust up, it can also adjust down. So there's a lot of people that had ARMs and the rates started to adjust downwards and they were thrilled. They didn't have to refinance. They didn't have to worry about any of that. The rate just adjusts with the market. Another reason somebody might pursue an ARM is because they might have to physically or legally be out of the country within a certain period of time. We've got people here on work visas that are like, I have to be out of the country in 5 years. Great. Let's do a 5-year ARM. Let's take advantage of a shorter rate in the interim. And then when you move, you plan on selling the house. Great. You'll just come out ahead in the long run. Now, when a lender qualifies you for a mortgage, we care about what we call the 3 C's. First C is what we call credit. Okay, so let's talk about credit. I feel like after college, people, you don't really like get grades in life anymore. And I feel like people love their credit score because it's like their grade in life. So people love hearing about their credit score. So mortgage lenders are going to pull credit. We are specifically looking at FICO, which is Fair Isaac and Company. Okay, it's a standardized algorithm to calculate a credit score. Credit Karma, NerdWallet, they all have their own algorithms they use to calculate a credit score. So if you get your Credit Karma score and you find out that your credit score on a mortgage is different, it's just because they're using a slightly different algorithm. In my experience, Credit Karma's score is great for predicting the trend of a FICO score, but not great at predicting the actual FICO score itself. So great for predicting trends, not great for predicting the actual score. Now within FICO, and specifically we're on the 8th iteration of FICO, FICO Model 8, there's 5 different components that make up your credit score, okay? 35% of your score is payment history. Simply put, have you made your payments on time, okay? And by on time, I mean, so long as you're not 30 days late, they're not going to report a late payment to the credit bureaus, okay? 30% of your score is amounts owed. And what that really should say is amounts owed relative to the amount you could owe. With a credit card specifically, and we're only talking about credit cards when it comes to amounts owed. And it's a sizable chunk of your score, 30% of your score. They want to make sure that you're not utilizing any more than 30% of your available limit. So if you have a credit card with a $1,000 limit, you want to make sure you're not using any more than $300 on that credit card. That's really important. We typically see the limits on our credit cards and say, hey, great, I can just borrow all that money. Yes, you could, but the second you go over 30% of your limit, your score is going to start to drop. And if you ever go over 50% of your limit, your score is going to plummet. So what we typically notice is in January, February, all those holiday bills from December are getting paid. Well, your credit scores tend to be the lowest in January and February because that's when people use their credit the most. Okay, so good rule, keep your credit to limit ratio to no more than 30%. A lot of people will push back and say, well, I use my credit card each month for miles, but then I pay the credit card off in full each month. That's all fine and dandy. However, they do not care about that part. Okay. Whenever that credit card statement generates and you get that credit card bill in the mail, that's the information that gets passed along to the credit bureaus. So if you're like most people and you don't pay your credit card bill until your bill arrives, well, by then that information's already been passed along to the credit bureaus and it's already too late. Okay. So even if you pay your credit card off in full each month, if you rack up a balance during the month, it'll likely drop your score. So keep an eye on that. One way to fix that would be to pay your credit card bill before it generates. Hey, my statements generate on the 1st of the month. Great. Log in on the 27th of the month, pay that bill off in full each month. And when you do that, but when the credit card statement generates, it's going to reflect $0 balance and $0 payment because you already paid it. So that's a good way to improve your credit score very easily, is just pay your bill before the bill is actually due, before it actually shows up, before it's actually generated, before that statement cycles. 15% of your score is length of credit history. So if you've ever heard somebody say, hey, you shouldn't close out any credit cards, they're talking about that. Okay, 15% of your score being length of credit history. If you do have 5 different credit cards, all things being equal, if you want to close out an account, you should close out the newer accounts. Okay. Unfortunately, people kind of have to learn about credit. So they start off with whatever credit card they can get. And then once they build up credit, they start to get a little bit more picky. Oh, well, I'm going to buy some mileage cards, or I'm going to use, we fly United or Southwest a lot. So I'm just going to get United or Southwest card. So once you become an adult, you tend to use credit a little bit more intentionally. Unfortunately, it's the oldest accounts that are really going to have the biggest benefit for your credit score. So just be aware of that. And credit cards are the single best thing you can do for your credit score. First of all, they do tend to be the oldest accounts you have. Car loans are 5-year, 7-year loans. Mortgages, people are constantly refinancing those. Student loans are going to get paid off eventually along with personal loans. So credit cards do tend to be the lengthiest trade line that people have. So yeah, just keep that in mind. And then again, 30% of your score is amounts owed. And specifically, 30% of your score has to do with your discipline with credit cards. So we're talking about 45% of your score having to deal with directly credit cards. So credit cards are the single best thing you can do for your credit score. If you don't have a credit card, get one. It's going to improve your score after 6 months. Okay. New credit is 10% of your score. That's referring to 2 different pieces. One, anytime you get a brand new account, it's going to drop your score for about 6 months. Okay, so keep that in mind. If you ever got a new credit card, it's going to drop your score for about 6 months. I was teaching at a high school earlier this week, and I had somebody come up to me afterwards, and they're like, "Hey, I just got a new credit card. My credit score plummeted." I'm like, "Yeah, it makes total sense. You only have 2 accounts, and one of those accounts is just brand newly opened. So wait 6 months. After 6 months, it'll start to help your score, but for that first 6 months, it's going to hurt your score." The second piece we're talking about with regards to new credit is credit inquiries. If you've ever heard somebody say, "Hey, you shouldn't have too many people checking your credit, it's going to drop your score," that's exactly what they're referring to. Okay. When you have somebody check your credit, it's going to drop your score between 3 and 5 points. It's only going to affect you for about 90 days. So it is minor, it is temporary, but yes, having a lender check your credit is going to drop your score a little bit. There's an exception also carved out for both car loans and mortgages. It only works for car loans and it only works for mortgages. Okay. Where if you have multiple lenders of the exact same type pulling credit, it only counts as one inquiry so long as it's done within a 14-day window. Okay. So 14-day window, multiple mortgage lenders, multiple car loan lenders can pull your credit and it'll count as only one inquiry instead of multiple inquiries. The government didn't want to punish you for shopping around for the best rates and terms available to you. And then finally, types of credit used is 10% of your score. Now, types of credit used, okay? This is kind of crazy. Please, please, please don't have a heart attack. They say, FICO says, you should have 3 credit cards for every 1 non-credit card, okay? That is absolutely wild. You don't necessarily need to do that to have perfect credit, but credit cards are good for your credit score. You don't have to have 3-to-1 ratio. That means if you had a car loan and a student loan and a mortgage, you should theoretically have 9 credit cards. Don't do that. It's completely unnecessary. But just know credit cards are very beneficial for your score. Okay. Alrighty. So beyond the credit score itself, and when we're talking about credit score, if we're over 680, we're going to be looking at conventional financing. Okay. If we're above 620, but below 680, we're typically looking at government financing. If we're below a 620, we may not have any options. And if we do, it's only going to be portfolio options. Okay. So plan A, 680 plus FICO score, government loans, 620 to 680, portfolio loans. There's no real set limits for what we can do with that. But lenders do tend to be a little bit more careful with their money than they are with the governments. So keep that in mind. All right. So beyond the credit score itself, okay, and it's rather important, but beyond the credit score itself, there are a number of things that will pop up occasionally. Late payments. If you're late, just get current. Just get current as soon as you can. I have had a few people try to apply for a mortgage when they're late on debt. Now, typically they're not aware that they're late. Most people wouldn't try to apply for a $300,000, $400,000 loan if they're currently late on credit cards. So it tends to be more accidental than anything. But get current. As soon as you possibly can, get current. It's going to help your score out. Collections. That is, you owed somebody money for long enough that they actually got a collection company typically involved to try to seek that money as damages or as repayment. With a collection, they don't typically have to get paid so long as they're less than a couple $1,000s. If they're more than that couple $1,000s, they typically will have to be paid in order to qualify for a mortgage. So it really just comes down to the amount. The government shifted their guidance on this because collections were becoming so prevalent, especially in medical collections. Every single time you go into the doctor's office, they ask for like confirmation of your address. It's because of medical collections, okay? So collections, if it's less than a couple $1,000s, likely will not need to get paid off to buy a house. Charge off. What is a charge off? A charge off is you owe a creditor money for long enough that they stop trying to collect it. Okay, it's not like a collection where they're still trying to get it. With the charge off, they've just given up. Okay, they've literally charged it off their books. That's where it comes. The name comes from. They've charged it off their books. They've taken the loss. You may feel like you fought the creditor and you won because they're no longer seeking money from you, but that's going to continue to follow you along on your credit report for many, many years. Okay, so doesn't necessarily need to be paid off to buy a house, but it is going to continue to drag down your score, and it's going to have consequences there with regards to rates, terms, all that. And then finally, judgments. Judgments are you legally owe somebody money. Okay, you legally owe somebody money. Typically, we see this with tax liens, outstanding child support, or outstanding spousal support. You lost a lawsuit. Okay, if it's a judgment, absolutely it must be settled and taken care of before you can buy a house. Okay, lenders don't want to put themselves at risk of somebody coming after your home. There's nothing that would stop a judgment from happening down the line. They can't really prevent that. But if they know about a judgment going in, yeah, you're not going to be able to get a mortgage. That's going to have to be taken care of prior to. All right. So I talked about the 3 C's. First C is credit. Second C is what we call capacity. And capacity has 2 different components to it. First one is down payment. Let's talk about that. So in lending, you're going to see a term called LTV, or loan to value. Okay, loan to value means your loan amount divided by the sales price of the house. Okay, if you're buying a house, I'm just going to use nice, easy numbers. Okay, if you're buying a house for $100,000 and you're getting a loan of $80,000, your loan to value is 80%. Okay, minimum down payment if you're buying a house as a first-time home buyer is 3% down for a conventional loan. For an FHA loan, it's going to be 3.5% down. I talked about how conventional tends to be a little bit better. Well, right off the get-go, conventional tends to have lower down payment than an FHA mortgage. 3% down as a first-time home buyer, 3.5% down if you're doing FHA, 3% for conventional. If you're a repeat home buyer for a conventional loan, it's 5% down for the down payment. Now, anytime you put less than 20% down, okay, you're going to have what they call mortgage insurance. Mortgage insurance is the one type of insurance in your life that you do not want. Okay, it's insurance you pay for, and it protects the lender. Okay, the good news with the conventional loan, and one of the big reasons we go conventional whenever we can, is twofold. One, that mortgage insurance is temporary in nature. Okay, that's a huge difference. That mortgage insurance will also change based on how much you are putting down. Okay, so it's temporary, and the more you put down, the less it is. Let's look at that real fast. So here's how much it costs for a conventional mortgage. For every $100,000 loan amount, if you get 3% down, it's going to be about $690 per year. So $690 per $100,000 loan amount per year. If you're getting a $300,000 mortgage, you'd multiply all these by 3. Okay, you do pay it on a monthly basis as part of your mortgage payment. Okay, so it's not paid as a yearly premium; it's paid monthly. Okay, if you do 5% down, it's $440 per $100,000 loan amount per year, 10% down, $290, 15%, $190. This all assumes a 740 plus FICO score. Now, we shop around mortgage insurance multiple times during the process. We shop it around once you get under contract on a property. We shop it around once we get the appraisal back. We shop it around at final loan approval. All mortgage insurance companies are going to offer the exact same coverage. So we go with whoever's cheapest by a nickel because there's literally no benefit to us or you to have any more of an expensive policy than you absolutely must have to get the loan. Okay, so mortgage insurance doesn't do you any good. The only good it allows you to do is put less than 20% down on a house. If you've ever heard somebody say, hey, you can do 20% down on a house, they're talking simply to avoid mortgage insurance. That's certainly not a requirement of getting a mortgage. With FHA, that mortgage insurance is permanent. It's more expensive, and they charge you both upfront mortgage insurance and monthly mortgage insurance. I talked about like, hey, conventional tends to be plan A. That's exactly why. FHA has more expensive, permanent, and you pay for it both twice, upfront and monthly. It's a ripoff through and through. The only way we go FHA is if we absolutely have to, and the only way to get rid of FHA's mortgage insurance is to refinance into a conventional mortgage. Okay, so we go conventional whenever we can. It's objectively so the better type of loan. With conventional, like I said, it is temporary in nature. You can have it removed in a number of different ways. Number one, it'll fall off when you are scheduled to reach 22% equity, okay? 78% loan to value means 22% equity, okay? Now, scheduled is the key word here. It's not when you do reach, it's when you're scheduled to reach. So if you did 5% down, it would likely be about 10 years into the loan, okay? So we don't want to go that route unless we absolutely have to. That is worst case scenario. That is, you fall asleep at the wheel, you make your payments on time, it'll fall off naturally at that point, okay? Number two, you can refinance at any point. And when you go to refinance, if you have 20% equity on the new loan, you're not going to have mortgage insurance. That one's kind of obvious, right? I had a member that put 10% down. They did a lot of work to their house, and this is literally a year ago, and they are refinancing and closing tomorrow. And when we did their appraisal, they have 20% equity. MI is not being required. It's great. They were able to save an extra $150 on top of what they were already anticipating saving with the refinance. Number three, within the first 2 years, if you actively pay down the loan and you reach 80% loan to value, you can petition to have it removed. Two caveats here. Number one, within the first 2 years, original value. Okay, they will not use any increase in value. If you're just petitioning to have PMI removed, a refinance is different. So they will only use the original value within the first 2 years. Second caveat, I mentioned you have to petition the lender, or it says on here, lender discretion. What that means is an appraisal is going to be required. Okay, we're going to have to do an appraisal to make sure the house is worth what you originally purchased it for. Okay. Number four, okay, this is by far and away the most common. After 2 years, you can petition to have it removed based on appreciation. So a brand new value. We're not limited to the original value after 2 years. Again, at lender's discretion, which means appraisal is going to be needed to make sure the house is worth what you think it's worth. And then finally, with this option, you need to have 25% equity. People always ask the question, why is it 22% equity in this scenario? Why is it 20% equity in this scenario? Why is it 25% equity in this scenario? Which is a reasonable question to ask. Well, the answer is twofold. One, this is an insurance company, so they want their money. Regardless of industry, insurance companies always want their money. And two, the government requires this kind of coverage. Their concern is that we're going to end up in like a California market where the houses increase in value 10% in 2 months, and then they decrease in value 10% later. They don't want to be at the mercy of that type of market fluctuations where, yes, PMI is required, and no, it's not. Yes, it is. No, it's not. They don't want to be in that situation. So they build in a buffer. By saying, hey, 25% equity, they're like, okay, great. We have a reasonable buffer, 5%, that if something were to happen, we have that extra coverage. Okay. All right. So capacity, down payment is one part. And then the second part is going to be debt to income ratio, which I'm going to talk about on the next slide. With regards to down payment, make sure your money for closing is either in a savings checking or money market account. Okay. Ultimately, you want your funds for closing to be in that account. That's what we call a liquid account. You can access that money today, tomorrow, if you needed to. Okay. You could use retirement accounts. With a 401k, you can typically take a loan from your 401k. They call it a hardship loan. I'm not sure how buying a house is a hardship, but they call it a hardship loan. How much you have access to, you're going to want to check with your 401k provider. It does differ provider to provider, account plan to account plan, how much you have access to. With a 401k loan, you are borrowing your own money and you're paying yourself back with interest. So it's actually not a bad deal at all. Just make sure you are able to repay that loan, because if not, there are significant consequences for early withdrawal. With a Roth IRA, you can withdraw the principal, the amount of money you've contributed. Okay. So if you put $20,000 into a Roth IRA and now that account is worth $25,000 because it's made $5,000, you can access the $20,000. You can't access that $5,000. Okay. That is perfectly fine for the purpose of down payment. You're going to have to liquidate those funds. So sell the funds and put into a savings checking or money market before closing if you're going to use it. IRAs tend to be hardest of the three accounts to access money from. Typically, IRAs are from a past employer. So it's not going to be a situation where you can really repay that loan because you're no longer actively contributing to that account. Those tend to be the hardest ones to access. 401k, Roth IRA are definitely easier. Stocks, bonds, mutual funds, so non-retirement brokerage accounts, perfectly fine. Again, you're going to have to liquidate those funds, get it into savings checking or money market account, and then you'll be good to go. Gift funds. perfectly fine so long as it's a relative or familial-like relationship. So blood relatives, pretty obvious. Grandpa, grandma, step parents, step siblings, all of that is perfectly fine. It gets a little bit more gray once we get beyond that. They do say adopted children are fine. They do say adopted parents are fine as family members. They say that ex family. So if your parents got a divorce and you're an ex spouse wanted to gift their other ex spouse money for the down payment, they do allow for that as well. And then beyond that, it really, really gets gray and kind of wiggly. You have to show that godfather, godmother, that would be okay. Beyond that, it gets kind of tricky. So familial-like relationship is what they're looking for with regards to gift funds. We would send them a gift letter that says this is a gift, not a loan. We do not expect repayment. We'd have to show the transfer of the funds occurring from their account into your account as well. And then finally, loans against an asset you own. We talked about one of those. So one loan against an asset you own is a 401k loan. Okay, that is your account. That is your money. You can take a loan against that account and use that to buy a house. Another example would be if you already own a house, you could take out a loan on that house and use that as a down payment, or a car loan. Hey, I've got a car. I don't have a loan on it. Well, great. You could do a cash out refinance on your car, take out that money, and use that money to buy a house. We would have to factor in those new payments for the debt to income ratio. Okay, and that's the second part of capacity. Capacity, again, is down payment plus debt to income ratio. So debt to income ratio is how a lender calculates how much you can reasonably afford. And here's the equation that lenders are going to do. Okay, so first things first, we're going to calculate your monthly gross income. Okay, whatever your salary is, we're looking at that number. Okay, we don't care about how much you pay for 401k plans or medical or any of that stuff or tax deductions. We're looking at the gross before all those deductions. Then, if you're playing the home game, you'll multiply that by either 35% if you're fiscally conservative or 50% if you are more aggressive. Okay. So, hey, great, I make $10,000 a month. Well, great. 35% of that would be $3,500, right? 50% would be $5,000. Okay, that's going to be a starting point. Then we're going to subtract out any monthly debts that show up on your credit report. Minimum payments on credit cards, car loan payments, student loan payments. If your student loans are in deferment, we have to calculate a payment at either 1% or 0.5% of the entire balance as though that is your payment. Okay. When we do that, whatever remains is the max housing payment we can qualify you for. Okay. So now that you know this equation, you kind of play the home game and get a reasonable expectation for what a lender can qualify you for. And people struggle with fiscally conservative versus aggressive. Well, look, if you have kids, or if you plan to have kids, or if you travel a lot and you don't want to change your lifestyle there, if you have a lot of expensive hobbies, great. You probably need to go with a lower number, okay? Because you've got stuff on the horizon that's going to impact how much you can reasonably spend each month. If you're dual income, no kids, no goals to have any kids, you don't travel a lot, you're a homebody, your home is where you spend your days and nights, it's where you love to live, and all your time and energy is dedicated to your home. Great. Probably feel comfortable going a little bit higher, up to 50%. So it just depends on how you work, how your family works as well. Now, beyond the housing payment itself, lenders don't really care about most of this, but you absolutely should. Maintenance and unexpected repairs. Okay, how much are you going to have to spend each month to take care of your house? You'll hear some people throw out numbers like, well, you should set aside 10% of your mortgage payment each month for unexpected repairs. Sure, it's a good starting point, but it's also a little bit flawed. Somebody could put a whole bunch of money down, have a very low mortgage payment, and have a very expensive house. No, it's not always the best approach, but at least gives you a starting point. But going forward, if you're currently renting, you're going to be buying, those repairs are going to be on you. Okay. I would also say, like, any of those rules, they're somewhat flawed because a house that was built in 1890 is likely going to have a lot more maintenance and unexpected repairs than a house that was built, last year. Okay. So take it with a grain of salt. The newer the house, the less maintenance typically that's going to be needed. Plan for a potential increase in utilities. We do not concern ourselves with that on the mortgage at all, but you absolutely should. If you're buying a house, you're typically upgrading. More house, more expensive, plan accordingly. And then HOA dues. We do take that into consideration when we look at your total housing payment that we are trying to qualify you for. So we will factor in HOA dues on our end as well, but you definitely need to take into consideration on your end. HOA dues, especially right now, have been increasing quite a bit. A lot of the insurance premiums on HOAs, condos and townhomes especially, have really been skyrocketing. They started to plateau a little bit, which is good, but there's a couple of really rough years in there. So the HOA dues have been skyrocketing along the front range. Be aware, plan accordingly. All right. So let's talk about the pre-approval process real fast. And then we're going to get to what does actually buying a house look like. So the pre-approval process. You're going to contact a lender. Okay. We'll have you complete a mortgage application. I can send you a link to that. You can fill it out in about 20 minutes. It's going to go over 2-year address history, 2-year work history, social, birthday, pretty basic information you'll know off the top of your head. It's also going to go over your assets, how much you have and who you have it with. Okay. We will get the application, we'll get credit pulled, and then if everything looks good, we will issue you a pre-approval letter. That initial pre-approval letter is pretty generic in nature, okay? It says, hey, great, so-and-so is qualified up to this sales price. It's not property specific, and once you do get pre-approved, it opens up a 4-month window to buy a house. So that's the time frame you'd be operating inside once you get pre-approved, okay? That initial letter really is generic. Hey, they've been pre-approved up to the sales price. Once it comes time to actually make an offer in the house, we will get you a brand new letter specific to the address and price. I do not want to tell a potential seller that you're qualified up to $800,000 if you're trying to make an offer at $600,000, because what are they going to do? They're going to ask you for more money. Okay, I do not want to impact your leverage or your negotiating. We will do up a brand new letter specific to the address and price of the house that you're making an offer on. Once you've been pre-approved, it is time to find a property. And in order to find a property, you need to have a real estate agent. So, selecting a real estate agent. You can start by asking your friends and family. If you have a good relationship with your lender, you can ask them. We work with very good real estate agents. I pride myself on only working with the best real estate agents. So you can ask a lender, okay? Ask that real estate agent and interview them. I recommend interviewing them. Ask them for references, okay? A good real estate agent will be over the moon, super excited to hand you references. Why? They're literally giving you names and numbers of people to contact that are their raving fans, okay? A good real estate agent will be more than happy to oblige, okay? Ask them for their experience. How much do you do typically in a year? How long have you been doing this? How long have you been doing this in this area? The market in Colorado is very different than the market in California, okay, or Texas. How much is a good number for a real estate agent to be doing? So this is why I say it really makes sense to interview them, for lack of a better term. The average real estate agent, and this is kind of mind-boggling, the average real estate agent does 1.5 transactions a year. A year. 1.5 transactions a year. What does that tell you? There's a lot of real estate agents that do this as a side hustle, okay? Next time you're in an Uber or a Lyft, just start talking to your driver. I'm shocked at how many have their real estate license. They do it as a side hustle. They do it for their friends and family. Maybe they do it for their own transactions, but it's not a profession for them. You want to find a real estate agent that's doing this as their profession, okay? If you're finding an agent that does 1 transaction a month, that is a very, 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 very productive real estate agent. 1 transaction a month is huge, okay? The best of the best do 2 per month plus, okay? So ask them how many real estate transactions they do. If you come across an agent that does like 8+ a year, I'd say that's a very good sign that they are doing this as a profession, not as a hobby, okay? So when you finally connect with that real estate agent, typically they'll take you out a time or 2 without having you sign something, or if they do have you sign an agreement, they'll have you sign a buyer's agency agreement for like 1 day. Hey, I'm taking you out on Saturday. Technically, I'm supposed to have this agreement signed, which is true, but I'm only going to make it for 1 day, okay? After this 1 day, we can kind of reevaluate our relationship and see how we're getting along. Great. They'll put you in their car, they'll drive you around, they'll look at some properties with you, and then you can kind of decide at that point if it's something you want to work with going forward, okay? When you do find that real estate agent and you do have that relationship, make sure you're communicating clearly and often, okay? Communicate clearly and often. Like every relationship, you get out what you put in, right? So put in that time and effort. Keep track of what you liked and you did not like about the property. It feels like you are being picky. I promise you, you are not. Okay. You were only helping them work better, work smarter for you. Okay. So please hit them up, let them know what you did and didn't like. It's just going to let them narrow that search criteria a little bit more for you. And something to be aware of in Colorado. So in Colorado, you cannot be a real estate agent for both the buyer and the seller. Okay. So I would ask that real estate agent when I find them, hey, what if I fell in love with one of your listings? Okay. How would that work? Because you can't represent both me and the seller. Would you hand me off to one of your colleagues? Would you represent me? Would you represent your seller? How would that work? So I would have that conversation in advance. One thing they could do, I'm not sure if it necessarily serves you well, okay, but one thing they could do is become what's called a transaction broker. Transaction broker is somebody that works between both parties, but they don't work for either party. Okay, they cannot help you negotiate terms. They cannot help you negotiate an inspection. All they can do is provide you with information and have you make the educated decision. So if you wanted to make an offer on a house and they were a transaction broker, they would say, hey, here's all the sales in that area. You tell me what price you want to offer. So they can give you the information, but they can't tell you what price to offer. I've got some agents that hate being a transaction broker because they can't separate themselves like emotionally from negotiating or working on behalf of somebody. And then I've got some that love it. They say it's the easiest job ever. They're just shuffling paper and trying to get the deal done. So yeah, definitely ask your agent when you're interviewing them, hey, what if I fell in love with one of your listings? How would that work? Who would be representing me? Who would be representing the seller? As you're looking at properties, you want to find out what is and is not negotiable for you. Okay. Life changes. Okay. Priorities shift. Location. School district might matter a lot if you're having kids. Okay. I've got people that specifically move to a specific area because they want to stay in the same school district. Okay. I don't have kids. I don't care about the school district. Okay. It just depends, right? It does impact resale value a little bit. But yeah, it just depends. Commute. I live in Erie. My wife works in Longmont. I work in Broomfield. It's great. It's equidistance between both of us. So the commute did matter a lot for me and my wife. It's a big part of the reason why we ended up living where we live. Life stage. If it's a ranch home, which, main floor living, basement as well, typically, but no upper floor. They tend to occupy a larger space, a larger lot, so they tend to be a little bit more expensive. We do notice that older generations tend to be drawn towards the ranch style homes, less stairs, easier to clean, easier to maintain. You don't have to worry about hauling laundry up and down flights of staircases, all of that. If you're younger, maybe look at a multi-level home. Okay, what we call a split level. You walk in, you have to go upstairs or downstairs, right? Or it's a tri-level home. Well, great. Those stairs might not bother you when you're younger. So yeah, maybe you can find a home that's a little bit less expensive that's multi-level versus ranch. Large yard versus small patio. Everybody says I want a large yard until they buy that large yard, and then they have to water that large yard, and then they have to maintain the large yard, and then they have to do fall landscaping. So pros and cons, right? We do notice also that the older generation tends to be attracted towards the low maintenance lifestyle, small patios. Ranch style homes where the HOA takes care of everything. We call them patio homes. So consider that as well. And then new construction versus existing home. I could teach an entire seminar on just that. They definitely have their pros and cons. New construction tends to be built closer to one another because their builders are trying to fit as many homes as they can in the space that they're given, especially along the Front Range. Land is such a premium, right? So there's one drawback. New construction, you're going to be living in a construction site for a while, unless you're the last home being built, right? So plan on having some additional noise. They can only lay sod down a couple months of the year. So if you're buying the house right now and they haven't laid down sod, which they probably haven't, you're going to be living in a dirt and dust for a while. Plan accordingly, okay? New construction, you're definitely paying a premium. With new construction, you will have cheaper insurance. That's one perk for sure. Less expensive insurance because the house comes with brand new warranties, and brand new warranties are an insurance company's best friend. Taxes tend to be higher on new construction. So what we call a metro taxing district, where they increase the taxes on that neighborhood to pay for the infrastructure. The roads, the sidewalks, the utility hookups, all of that requires money, and they increase the taxes on new construction areas to pay for that. I'm not necessarily against new construction. I bought new construction before. It was not my favorite experience, I will tell you that. But with new construction, make sure you're going to be in the house long term. The reason that's so important is because if you bought new construction and you had to sell your house a year or two later, well, if the builder is still building, you're going to be at a significant disadvantage when it comes to sell the house. It's going to be very tricky to do so. Why would somebody want to buy your house when they can just go directly to the builder's office and pick out what they want and where they want it? Okay. Existing homes, kind of the opposite issues. Okay. They tend to be a little bit older, so they tend to be a little bit further apart. Your insurance is going to be more expensive because your roof is older. Your taxes are going to be lower. You're not going to be living in a construction zone, most likely. More mature landscaping, so a little bit more privacy as well. Yeah, pros and cons to both. Again, I would just say if you are looking at new construction, make sure it is going to be a longer term home for you. And I would say, as a first time home buyer, especially, be careful there. Only because oftentimes you don't know what you want until you actually buy your own property and live in it for a bit. And then you're like, oh, I wish I had done this differently. I wish this was a little bit different. A lot of people look at new construction for like their final home, their forever home. But yeah, your first home doesn't tend to be lived in as long. It tends to be a shorter term stay for you, 3 to 5 years. Well, great, if the builder's still building, again, you're going to be at a competitive disadvantage there. Now, when you are visiting properties, make sure you bring a notebook. Take pictures, that's nice. Be careful. Don't take pictures of their family, portraits and stuff like that. But if you're seeing pictures online and doesn't quite jive with what you're seeing in person, yeah, take a picture so that you can kind of reconcile that later on when you're trying to remember all these different properties. Bring a tape measure if you have very specific stuff that you have to fit in the house. Had somebody that had an old antique pool table, and it was one of their criteria for buying a house was I need a place to put my family heirloom pool table, so they need enough space. Great, bring a tape measure. You'll be shocked how few times you'll be in that house prior to closing. Typical first showing. Typically, you'll do a second showing to make sure you love it. Inspection, you very well may be present at the inspection to make sure nothing's wrong with the house with the inspector. And then final walkthrough. You might only be in that house 2 to 3 times prior to closing on that house. So take advantage of the time. Make sure you make your showings work for you. Ignore easily replace cosmetic features. You'll hear the line, paint is cheap. They're not just talking about paints. They're talking about paint and floor and anything that's cosmetic in nature that you can fix relatively quickly and easily and cheaply. Okay, ignore those. I bought an investment property a few years back during COVID-19, and I was like, why is this house still on the market? And the only answer I got from anybody was, it's the SpongeBob yellow paint. they couldn't, no buyers could see past the SpongeBob yellow paint that was inside the house. I'm like, paint is cheap? Great deal. I got it for a discount because of the paint color. And yeah, it's turned out to be a great rental. Evaluate the storage areas. Make sure that you're going to have enough space to grow into. Walk around outside and look over the exterior and listen to the neighborhood. I would also say try to stagger your appointments. Okay. If you do your first showing at 10 a.m. on a weekday, try to schedule your second showing for 5:30 on a weeknight so that more people are home, so you can experience more what it's like to actually live in that house instead of just the time when everybody's off at work. Okay. So try to stagger your appointments. Walk around outside, look over the exterior, and listen to the neighborhood. Okay. People ask if I would ever not buy a property just because there's one noisy neighbor. Not necessarily. They might be renting, right? But if everybody's noisy in the area, yeah, that's gonna may or may not be the type of party I want to sign up for. All right. So one of the first things you're gonna do once you get into contract is you're gonna do an inspection. Okay. You're gonna hire an inspector to make sure that there's not any health, safety, or livability issues with the house. Make sure your house is not a lemon. Now, there are a few things you need to be aware of along the front range. Okay. One is radon. If you have a basement, you definitely need to test for radon. Radon is a radioactive gas that seeps in through the foundation of your property. Okay. It's very, very cheap to test for, like literally $100, $150, I think max, to test for radon. And it's much more expensive to mitigate it. They basically have to install a fan that runs through your house. It's not a loud fan. You'd only maybe hear it in the basement. It's actually a pretty quiet fan, but it's a process and it's expensive. Okay. So radon, if you have a basement, test for radon. It's cheap to test for, expensive to mitigate. Bentonite. Bentonite is an expansive clay in the soils. if you've lived in Colorado and you're like, hey, why are the roads so bad? Then like bentonite. It's literally the expansive clays in the soil that are, heaving and hoeing, and they are expanding and contracting, and that causes all the cracks and sealant being needed on all of our roads. It also creates foundational issues in homes. Okay, can lead to structural issues with homes. Some areas are hit harder than others. Miramonte in Broomfield. There's some areas that are hit hard with bentonite in that area. Rock Creek in Superior. Some cul-de-sacs are just completely torn apart by construction, structural issues. And then you go one cul-de-sac over and it's perfectly fine. It's bizarre, but it literally goes in veins in the ground and it can wreak havoc. Your basic inspector will know what to look out for, and they will advise you whether or not you should get a structural engineer out there to look at that. So start with the basic inspector unless you have any obvious concerns on your own end. They will tell you whether or not additional inspections are warranted on that. And then mold. Mold was not an issue in Colorado for the longest time. And then we had the 2013 floods. And that all of a sudden started to cause mold issues in an otherwise arid climate that we are not accustomed to seeing them at. Again, your basic inspector will know what to keep an eye out for. Hey, there's some black spots on the wall. Yeah, no, we need to get somebody out here to test for mold. It might not be in their purview. They may not have the ability to do it, but their job is to cover their you-know-what and make sure that you're buying a sound investment. If you're buying a condo, there are additional things you should concern yourselves with. Okay. Number one, adequate parking, right? Revisit it, like I said, at different times. Revisit in the evening when people are actually home. You're going to get a better sense for how the parking areas are. Shared walls, again, try to listen to your neighborhoods when they might be home. If you always see that property at noon on a weekday, you're going to have a very different experience when you're actually trying to get some sleep there at 10 o'clock at night. So try to visit when your neighbors are more likely to be home. Common areas, are they well maintained? You're paying HOA dues. You need to make sure that your HOA dues are going towards taking care of the property. Okay. Is the paint peeling? Is the landscaping well maintained? Are the sidewalks clear? Are the common areas well maintained? You are paying HOA dues to make sure that they are. I would make sure that that's a good value for you. And then homeowners association itself. When you buy into a condo or townhome, you are now part of that HOA. You are part of the homeowners association. You are indeed a homeowner. Review the rules, fees, and regulations very carefully. You might be shocked to see what's in there. Okay, it is very boring reading. It is not fun reading, but you absolutely must, hard stop, read those covenants and restrictions. I've had numerous people take the seminar, not do so, and then they get a very nasty surprise once they actually buy that house and close on it. Most extreme example, I had somebody that didn't read their HOA rules and regulations, and the HOA said, hey, you can have 2 dogs, and neither one of them can be over 75 pounds. She had 3 dogs, and 2 of them were over 75 pounds. So she had to give away dogs or sell her house. She literally decided to sell her house. She ended up losing money on it because she had to pay real estate commissions and everything when she went to sell. So read those rules and regulations. It's imperative that you do. And then there's some additional rules with regards to condos that lenders definitely care about. So take a quick second here. So number one, okay, the complex cannot be in any litigation. The HOA cannot be suing anybody or being sued. We've seen all sorts of litigation occurring. We've seen slip and falls during the winter. Somebody slips and falls on the concrete while the HOA is supposed to maintain the common areas. So that was a litigation that came up. I saw a homeowner was doing a birthday party. They bought an inflatable bounce house, and the company that they had hired to do it didn't attach it properly into the ground. A gust of wind came, picked up the bounce house, threw it into a tree, and a kid got injured. So they sued everybody. They sued the bounce house company. They sued the party planner. They sued the parents that hired it all. They sued the HOA. They sued everybody. Litigation is extremely troublesome when it comes to getting HOAs approved. Builder defects is another very, very common one. The condo is up and running, everything's going fine, and then all of a sudden they start to notice, hey, there's some leaking going on here, and they find out that the builder didn't do something correctly, and they are suing the builder. That's very common litigation. I'd say almost most common litigation. It also cannot be a condotel. What's a condotel? So a condotel is any condo that also has some features of a hotel. They have short-term rental desks, they have concierge service, they have housekeeping on site. They might have literally a short-term rental desk where you can literally walk in and just rent properties by the night, like it was a hotel itself. That's going to be a condotel, and the government's not going to want to do anything with condotels. Your insurance policy on a condo policy cannot have wind, fire, or hail deductible that exceeds 5%. We've been seeing that more and more often. The complex must be setting aside at least 10% of their money for reserves. What does that mean? Well, we're going to look at the budget for that HOA, and we want to make sure that however much they're collecting, that they're setting aside 10% of that for a rainy day. Rainy day could be unexpected repairs. It could be covering insurance deductibles if they ever had a claim, any sort of thing. But it's good financial policy to set aside money for reserves. This does only apply if the borrower is putting less than 10% down. Okay, so if you do 10% or less down, we have to do a full review. If you do more than 10% down, we can do a limited review. Okay, so this only pops up when we do a full review. 15. The complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. We don't see that very often. We saw that briefly during COVID-19. We saw it a lot during the Great Recession, 2008, 2009. But we have not seen much of that lately. And then 20, the complex cannot have one owner who owns more than 20% of the units. The reason for that one is the government is worried that a owner who owns too many of the units, if they were to go into financial distress and have to go into like bankruptcy, they would flood the market with 20% of units, and that's going to drag down your value due to supply and demand. Okay. They carve out an exception if the owner is a municipality doing like affordable housing or subsidized housing. So the city of Boulder buys up a lot of units, and sometimes they bought up more than 20%. And they did that as for low market rentals. Perfectly fine. The government's not worried about, city of Boulder going bankrupt. They're worried about private individuals going bankrupt. Finally, 35, the complex cannot have 35% or more of the square footage be commercial in nature. The government just doesn't want to be too attached to commercial. They are really invested in residential. They believe that's a foundational core of, the American dream and the American economy. They're less infatuated with commercial. So commercial loans are almost always private loans, portfolio loans. Okay. And then finally, sometimes 50. When the purchase of the unit is an investor and they are putting less than 20% down, at least 50% of the units must be owner occupied. This does not come up very frequently because more and more investors are putting 25% down. It used to be a problem for quite a while. They did not have that 25% down portion in there, and it was coming up constantly that condos were what we call non-warrantable. And non-warrantable simply means they don't meet these requirements. Okay. All right. So, you spoke with a lender. We got you pre-approved. You spoke with the real estate agent. After interviewing, you found exactly the real estate agent you want to use. You started looking at some homes, kept a very detailed list of the homes, the features, what you liked and what you didn't like. Started having them to kind of nail things down and narrow that criteria. And then you finally came across the property you want to make an offer on. How does that look? Well, first, you're going to discuss the offer amount and the seller concessions with your real estate professional, with your real estate agent. Okay. And what are seller concessions? Seller concessions are costs that the seller pays on your behalf. And it is always a negotiation. Okay. You can have the seller pay for your closing costs. Always it's a negotiation. So a good agent will tell you what's a good offer price, whether or not there's going to be any possibility of trying to get the seller to pay for some of your costs, seller concessions. They will then present you with the purchase contract, and it is a standard document in Colorado. Okay. They're going to help you fill in all the blanks, but it is a standardized document that the Department of Regulatory Agencies releases every year to them. So the real estate agent, unless you're buying new construction, is going to use a standardized document in Colorado. If it's new construction, you're going to be signing the builder's contract. And the builder's contract gives the builder a lot of protection and you very, very little. Okay. When you play with the builder, you play by the rules. Not the case with other transactions. The standard contract gives you a lot of protection. Okay. Now, once they accept your offer, okay, you are going to submit earnest money. What is earnest money? Earnest money is a deposit you make at the very beginning to show that you are proceeding in good faith or you are proceeding in earnest. Okay, it's where it gets its name. It's not some guy whose name is Ernest. It shows that you're proceeding in earnest. Okay, it is money deposited at the very beginning to show proceeding in good faith. If you do not do what the contract says you're supposed to do, when you're supposed to do it, you would sacrifice that money. Okay, that's the bad news. The good news is, in Colorado, the purchase contract is extremely buyer friendly. If you do not like your inspection, cancel. You get your earnest money back. Okay. If you do your appraisal and you don't like the results, cancel. You get your earnest money back. Loan terms deadline. At the buyer's sole subjective discretion, if you do not like the terms of the loan you're being offered, you can cancel. You can get your earnest money back. I've been doing this since 2009. I've only seen one person sacrifice their earnest money. Okay. Somebody had bought a house sight unseen during COVID. They'd literally never seen the house. They come out here to do their final walkthrough the day before closing. And they're like, yeah, I can't live here. They did all the virtual tours and everything, but it looks very different in person, and they just couldn't come to terms with it. So, yeah, so long as you're not doing anything crazy like that, you're going to be okay. Good agent and a good lender, our jobs are to protect your earnest money. We will send you an updated pre-approval letter specific to the purchase price and the address. Again, I do not want to tell them you're qualified for any more than you actually plan on offering. And then I would say expect a counteroffer. On the vast majority of transactions, we get a counteroffer. Okay, they may disagree with the price you're offering. They may disagree with the dates. They're typically going to counter something. It's very rare that we get a signed contract right off the bat. There's usually a counteroffer associated with it. Once you get a fully executed contract, so both you and the sellers have signed it, along with your two agents, you are officially under contract. What's going to happen next? Well, we're going to update your application, make sure nothing's changed since we started. No new jobs, no new debts. Make sure we know where your down payment's coming from. We'll update that in a matter of minutes. You'll give us the copy of the purchase contract. We will then send you a bunch of different loan options, and we'll discuss what's going to be best for you based on your needs and desires. At that point, we'll discuss whether or not we should lock in the interest rate. Okay, should we lock? If the market is starting to erode and rates are going to go up, absolutely. If rates are expected to come down, or there's good news in the markets that could portend lower rates, maybe we decide to float. We just hold tight and we don't lock in just yet. We'll discuss that. We will then send you your loan disclosures. You'll electronically sign those. It's all done online. And then we'll send you a list of what we need to process your loan. 2 years of W-2s, 30 days of pay stubs, 2 months of bank statements. That's the vast majority of it if you're a W-2 employee. You are then going to schedule your inspection. Again, inspection, they're concerned about health, safety, and livability concerns. They're looking out for radon, expansive clays, bentonite, mold. They're taking a look and making sure that you're not buying a lemon. We, at the same time as you order the inspection, will order the appraisal. The appraisal is ordered through an independent company, okay? They do not work for Elevations. They are not employees of Elevations. They have been approved by Elevations. We do not want just some random person coming out to do an appraisal. So they have been vetted. They have been approved. We are very, very tight with our appraisal panel. By that, I mean, we will not let anybody get on it. We keep it very, very tight because we know they are a reflection of us, okay? So it is valuation of the property ordered through an appraisal management company that we maintain the panel on. If that appraisal comes in high, you are the only one that knows, okay? We will tell everybody else in the transaction that the appraisal is in at value. And occasionally I have an agent push back at me and say, in at what value? And I say, I cannot reveal that information, okay? Suffice to say, sufficient for our purposes. If it comes in high, you are the only one that is aware, okay? We do not want to tell anybody you're buying the house for a discount, okay? If that appraisal comes in low, there's a few different options. One, we can go back to the appraiser and ask for a different value, okay? We can say, hey, appraiser, you missed this or this or this, and because of that, we disagree with your valuation. Give them a chance to make it right. Appraisers are human. Occasionally, they make mistakes, okay? Or, if it comes in low, your agent could ask for a different price. Hey, we're buying this house for $450. It appraised at $425. We want this price to now be $425. I've just given them, unfortunately, some additional leverage that they could use to potentially negotiate a lower price, okay? So that is potentially an option as well. Good agents are okay with a low appraisal because they see it as additional leverage. Another option is you could bring additional cash to closing. We saw that happening a lot during COVID-19. People were, for the first few months of COVID, everybody kind of locked themselves in their homes, and then they realized, oh my gosh, I locked myself into a house that's not nearly as big as I need because now my house is my kid's school and it's a gym. Like, just way too much going on in such a little space. So people were overpaying for homes left and right. They were doing appraisal waivers where they would say, hey, whatever the difference is, we'll cover it. Appraisal gaps where they said, if it comes in low by $20,000, we're good for it as well. We were seeing that happen a lot. Every new sale was kind of setting the new limit for that neighborhood. So you could bring additional cash at closing. Hey, it appraised for $425. We were under contract at $450. We're just going to pay the $25,000 difference out of pocket. Okay. Or negotiations happen. Sometimes you meet somewhere in the middle. And then finally, you could just walk away. You could cancel, get your earnest money back per the appraisal deadline. Okay. Some pitfalls to avoid. Make sure you are not applying for any new credit during the loan process itself. Okay. I mentioned that, it seems kind of obvious, but when you're buying a new house is exactly when you want to go get new lines of credit. Hey, yeah, I want to get that Veterans Day washer and dryer sale that's going on at Home Depot. Yeah, exactly. When you're buying a house is exactly when you want to get new debt. But lenders are required to do a credit refresh 7 days before closing to make sure you haven't gone out and done anything crazy like that. Okay, so if you do, please let us know. We will find out, like I said, on that credit refresh. So just be open and honest with us. Hopefully, we can kind of get ahead of it. But otherwise, do not apply for new credit during the process. Try not to make any unnecessary large purchases or withdrawals or deposits, particularly deposits. When we get your bank statements, if it shows a large deposit, which is considered anything over 25% of your pay, we have to find out where that money came from. That can be sometimes very clean. It can also get very, very muddy very, very quickly. So again, communication is key. Just be open and honest with us. We can tell you how best to go about documenting that. And then, yes, please provide the documentation as quickly as you can to us. Once you get on a contract, we typically say 3 days. Again, it's a pretty short list. 2 years of W-2s, 30 days of pay stubs, 2 months of banks. It's a pretty short list. But if you can get us that information as quick as possible, that would be great. Once we get that documentation, we're going to send your file along to the underwriter. Okay. The underwriter's job is to review the documentation we provided, review the guidelines for the investor, Fannie Mae, Freddie Mac, FHA, whoever, and make sure that the documentation we've supplied matches up with their guidelines. Okay. They typically will then issue what they call a conditional approval. Hey, great, your loan is approved. Pending, you have to finish your insurance policy. Pending, hey, we have to get that appraisal back. Pending, hey, we had 5 of 6 pages of your bank statement. We need 1 more page. Okay. Pretty easy stuff. We then send you that list. You get that documentation back to us, and then we send the file back to the underwriter for final approval. And then finally, closing. Okay. Closing in Colorado is done at the title company. Okay. We do not use real estate attorneys in Colorado. We use real estate agents and title companies, and together they satisfy the function of what real estate attorneys would do in other states, but they do it for a fraction of the cost. Title companies do a lot of different things. They collect funds and they disperse funds. So instead of having to write 20 different checks for 20 different fees, like your appraisal or process or underwriting, credit report, all that, you write 1 check at closing. Title company takes that money and then they pay everybody that is owed that money. Okay. Second thing they do is they execute closing itself. They will print off the documents you need to sign. They will have you come to the closing table. They will explain all the documents you're signing, have you sign it, notarize it, and then they record it with the county after closing. So they handle the physical act of closing itself. For closing, once we balance the final figures called the closing disclosure, we will review those numbers with you, and then you can either wire or do a cashier's check for that final amount. Okay. I pride myself on my numbers being extremely accurate. So when you get that final numbers, you're going to be pleasantly surprised. If you've been working with me, my initial estimates, I always kind of build in a little bit of a buffer so that you're not going to get any nasty surprises as part of closing. But yeah, final funds for closing need to be either wired or a cashier's check sent to title. You will then physically go to the title company. They are everywhere. They go in like blocks. So there's some areas where everything is a title company. They're all very consolidated. Make it easy for real estate agents. They can just kind of, closings in Westminster. We're just going to head over that direction because I know where all the title companies are. You and your agent will sit on one side of the table. The title rep will sit on the other side of the table. I'll sit on the opposite end of them. And then again, they'll present documents, explain exactly what you're signing, have you sign it, record it after closing. And then it is the wild, wild west in Colorado. When you sign and you turn over your money and we wire our funds to title company, you will sign on the dotted line and you will get keys to that house. It happens that exact same day. That's not the case in a lot of states. A lot of states have what they call an escrow period where you sign on the dotted line. You have to wait a period of time before the loan becomes official. Not the case in Colorado. It is all official that day. We send our docs, we send our wires the day before closing to make sure nothing goes awry. And that is it. After that, you have officially bought a new home. Alrighty, so got a little bit of time for questions. If you have any, please feel free to drop them in the Q&A. I've got my eyes on that. Otherwise, all my contact information is here. If you have anything you want to take offline, feel free to grab my email address or my cell phone number. You can text me, call me, email me anytime. Happy to help however I can. I'm going to stay put for just a couple minutes, make sure no questions pop up. And then, yeah, I'll turn you loose a few minutes early. Don't see any questions yet. See, Savannah is typing. Of course. My pleasure, Savannah. Thank you so much for attending. I really appreciate it. If you think of any questions, let me know. Drop me an email, shoot me a text. Happy to help out where I can. Thank you so much, Savannah. I appreciate that. All right. With that, I think I'm going to say goodbye. Have a great rest of your day, Savannah. And yeah, see you next time. Thanks.